Greetings, it's Dr. Jeffrey Scott, and this is my weekend market update for 6/26/2022. My email address is hgsidoc@gmail.com, and I entitled this Strong Week, But, and I'll show you the buts. If you're new and you like to subscribe, hit the subscribe button and the alarm so you know when I post these. I appreciate thumbs up. Thumbs down will give me information too, and if you have any comments, either email me or put them in the remarks section on YouTube. I am on the road on vacation, and I wanted to do a quick video tonight. The audio is going to be dependent upon my computer and not my setup that I use at home. So I apologize in advance. This is for education purposes only. Anything I say should be taken in that spirit. I'm a doctor, not a broker. I use the tools that I use every day in these demonstrations, and trading involves risk, and you are solely responsible for any investment decisions you make. I just want to remind everybody about the upcoming Wealth 365 event. It's a great week of education, opportunities to pick up Wealthcharts at the best price of the year. Hopefully they're still offering annual and founder memberships. They come with some great extra free indicators. And then a lot of folks, including myself, will be speaking and offering some packages as well. The program starts July 11th and runs through the 16th. I'll be speaking on Wednesday the 13th at 11 a.m. and again at Friday at 6 p.m. Friday the 16th at 11 a.m. Hope to see you there. I also post videos nightly actually daily, I should say, because they get posted early in the morning before the market opens at stocksanddocs.com. They're similar to what I'm doing here tonight, but they are much shorter. All right, now we've killed that. Let's take a look at the market spreadsheet that I like to look at. And we'll start up here looking at the major indices. And I always look over here and I put in, I guess it's yellow, the major indexes. You can see the NASDAQ and Russell are still down about 28% on the year. The S&P is down 18.7 and the Dow 14.7. Perhaps most interesting is they're both each of these are 7 or 8 days off the lows, with a move ranging from about 6% up to nearly 10%. So the market has seen a very big rally. Part of the on my title is that this was a rally of junk off the bottom, which I'm going to show you. Yes, the spider was up 3.2. Awesome, awesome one-day move on Friday. And then NYC was up 2.8. But take a look at ARC Innovation. It was up 4.1. And on the week, including the previous Friday, since Monday was a holiday, 24% move in 5 days. That's pretty impressive. When you look at the sectors, you can see the big losers are consumer discretionary and communications, and energy, which had been up or flat, is now down 23.3% as energy has rolled over. When we look at the markets, you want to see how much we've improved. We are now 35% of the stocks in the S&P 1500 are trading above the midline of their Bollinger Bands, very few below. And when you look at sectors, industries, and stocks above 90% and 100 on sectors across the board in the S&P 1500. If you look at 10 days ago and a month ago, it did not look like this. So the market staged quite the rally. Now, I said junk off the bottom. Let me give you more data to support that. If you look at, and we throw out the tail and the head because there's very few stocks. If you look at low ERG stands for EPS rank plus relative strength rank plus group rank, the low ERG stocks really outperformed. And in fact, when you see this curve going down, that means the better quality stocks actually underperformed. And when you look down here with 1 week return versus EPS rank versus relative strength rank, the better performers on the week were the worst stocks from a fundamental perspective. And the ones that led the prior week underperformed the ones that were laggards. So this was a laggard rally, not a leader rally. Now, we don't expect to see a Hindenburg omen for quite some time. I want to point out that the weekly bongo is still painted red, and that's just my longer term trending indicator. That just shows how tough this market is. And on the NASDAQ, even though we had a very good week, we still had quite a few new lows. and almost no new highs. So the NASDAQ remains weak. Although if you look at the 1 week performance, up 9%, 3% on Friday. And again, this includes the Friday of the prior week because it was a Monday holiday, and 8 days off the low, nearly 10%. All right, if we look at the NYSE, you'll see the similar thing. Put here what I forgot to do because unfortunately the weekly bongo maintains red on the NYSE as well. The only difference here is that we're starting to see less new lows, and in fact on Friday we got below 1%, still no new highs, and again 5-day 4.7, 1-day 2.8, and 5.8% off of its lows. The buckets a week ago, this is what we looked like. 96% of stocks below the midline and over 20% below the bands. Now we're at a much more neutral level, not overbought by any means, but much less oversold. My goodness, 35% of the stocks now above the midline of the Bollinger Bands. If we look at energy on the week, we could see some big negatives in natural gas, UK gas, and the US natural gas. Crude oil firmed a little bit, but was still on the week was flat to down. If I look at metals, look at copper, steel, and ore. Copper's just gotten hammered. Just look at a 4-hour chart going back the last month. And you can see 11.67% down in the month, 12.4% down year to date. The dry Baltic index has also come down as well, which will hurt stocks like Starbuck and Zim. Interest rates, 10-year and 30-year came down this week, which is good if you're a bull. If we look at these spread things, the concerning one is the one on top, and that is the credit risk. And we continue to push higher, now approaching the highs of late 2018 going into 2019. Why does this matter? Because this is what happened when the credit risk went up. So this shows evidence of credit tightening, which could be a problem for this market. If I look at overbought, oversold, both the stocks above the 200, stocks above the 40 bounced this week. And then my good old trusty T2121, the 13-week new high, new low, moved right off expected, as we talked about last week, as we talked about the live meeting in Irvine, California. It was pretty obvious to us that we'd see a reversal because every time it touches or gets close to this line, it bounces. Even the McClellan oscillator bounced off of what had been support. Now, you notice there were a few times when it got even worse, so I wasn't expecting this reversal, but we got it. Economic news this week, durable goods on Monday. Tuesday, we've got more goods and consumer confidence. Wednesday, Powell speaks. Now, notice he speaks right after the GDP comes out. Does he already know the result? I bet he does. And is this going to be a victory lap that he's getting a soft landing? Or perhaps is it going to be signs of a increased need for tightening? We got some energy status. We got some bond action, jobless claims on Thursday, and we don't get the monthly unemployment report. We do get an ISM on Friday. We don't get the monthly unemployment report for the simple reason that they don't do it usually when Friday is the first of the month. Earnings, not a busy earnings weeks. A lot of Micron's a pretty, well, it used to be a pretty widely held stock. You know, I always say that it's a judgment call to hold the stock over earnings. It's bad judgment to not know when your earnings dates are. From an expected moves chart, I'm going to go very quickly this because I am on vacation. On all the major futures, the E-minis, the NASDAQ, the YMs, and the Russell, they blew through the top range. And you could see most of that action came on Friday and on Monday. Tuesday, because Monday was closed. So Tuesday, big day, Wednesday, Thursday, sideways, Friday, a big day. So that is unusual to see all four at the same time. And interestingly, they all broke below the prior week. VIX came down, closed at the bottom of the expected range, and the dollar pretty much stayed kind of neutral. So my thoughts, good week for the bulls, but the market was led by laggards. Friday qualified as a follow-through day, and IBD now says we're in an uptrend. OBOS, oversold, improved this week, got the bounce we expected. Energy continues to roll over. Will this relieve some inflation pressure? Put in the back of your mind, the markets will bottom before we see improvement in the economy and hear about it from the Fed. This is the 12th time since the market started to fall that we saw the spider up 2%, and pretty much the first 9 failed. Again, another huge news week. One more time, Wealth 365 is coming up. It's actually, I think, 14 days from now. I'll put the link in the remarks in YouTube. And then just to remind you again, daily videos. Sometimes I record at night, sometimes in the morning beforehand. They're posted before the market opens at stocksanddocs.com, no charge, and maybe you can get something that you can find useful. All right. Now, let's go look at wealth charts. And I don't normally start at the seasonality slide, but I wanted to start here for a reason. And the reason is we're actually going through a week now of strong seasonality. Probably, if I had to guess, we're going into the summer rally period. Maybe we get a rally. But positive seasonality, perhaps because of 4th of July. If you look here, the spider sectors over the next 4 weeks, you could see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 9, so 8 of the sectors are up, and communications and real estate are never up because, well, they're never up on a 10-year view because they're not 10 years old. I pointed out technology because technology's been tough. But you can see it's up 10 out of 10 years with an average return of 4.32%. It may be different here because this is more than 4 weeks, I suspect, if you look at the actual time. So this is a stronger seasonality time. And I'm not advocating buying Apple, but just to give you a sense of what in technology might be interesting, here's Apple up 9 out of 10 years from June 28th to August 2nd, 6.22%. A big rally in Apple and Microsoft and others in this group could certainly give us much more to this follow-through day and market uptrend than we've seen from previous bounces. Still have to see it happen. Just because it says it's done it the last 10 years doesn't mean a thing sitting here on Sunday night. Here we are looking at the major indexes. And again, I'm trying to go quick today. And it's a simple story. Look at the size of these bars on Friday. Gapped up, closed at the high of the day on the spider with a new EMS and a new daily bongo green. The Qs, the Dow rather, and the Russell all look similar, all with pretty impressive moves. The VIX actually traded down, not a big surprise, and the dollar drifted down, which supports this rally. I just want to remind you, if I go to a weekly view of the spiders and I enlarge it, that I've been looking at this really as 3 legs down. Here was the first one, here was the second one, and I thought we might run down as much as 18% to what was the prior highs of February 2020. We have bounced, and that's great. We don't have to hit this. Where do I think we might end up? First, we got to take out the highs here, which is about 417, and then let's get up to 435-ish, where the 50-day moving average or 50-week moving average will be. We could make a run here. I don't think it's over. Why do I not think it's over? Besides, maybe I'm a pessimist. Because if I look at the guppy charts, I've got to get above these moving averages before I call all clear. And we're nowhere close on any of the major market ETFs. On the commodity front, gold and silver are languishing below their 200-day moving averages, so we don't care about them. Oil. Now, this is interesting because oil broke down below the 50, failed on, looks like Wednesday. Thursday sold off, and Friday failed again at the 50. 2 fails at the 50. That's an ice hole failure if I ever saw one. If it doesn't get above that 50 quickly and hold, I'd expect it to come back down here in the $74 range and retest at this prior lowish area. Again, natural gas has broken down, and it bounced so many times off of trendline support, and this is what happened when it failed twice. Not only did it take out the 50, it's traded down and reversed all of the run-up since April. 10-year pull back towards the 50 on Thursday, traded up a little bit on Friday. If we look at market theme, still about large caps and value, but look at this little line here. It's showing us that growth might be making a bit of a move. That will be exciting. If I look at the S&P 500 sectors, materials and energy clobbered, financials clobbered, industrials neutral, technology neutral, staples look strong, and healthcare looks strong. Staples, healthcare, maybe industrials coming up behind them. If I go into my set of dashboards and I look at the heat map, you could see the big caps had a great week. I go into sector scanner and we look at the major sectors, which are right here, and we look at weekly change. You could see that healthcare, technology, and staples were the leaders. If we looked at those, we can look at what the leading industry groups are, and we could identify the top bunch. We could then hit compare, get the leading stocks, and we could put those into a watch group. I've already done that, so I'm going to move forward. I'm going to go into Wealth Scanner, where I'm looking at just the major indexes and the ETFs of the major different sectors and industry groups. And just so people are aware, I changed my setting to day trader because I wanted faster movement here. What it shows me is that China and solar lead. We talked about DQ last week. That wasn't a bad pick. I've also been talking a lot about biotech and pharma. Here's biotech, and then short the bonds, the dollar, and pharma and biotech again. Now we're dropping below 200, so I'm not going to go much further, but it's a narrow leadership. And let's take a look in the CAT scanner. Now the CAT scanner, let's just go down to my weekend bulls, which are the list that I saved earlier. And the stock that comes up to the top, I think, is actually an interesting stock here, and that is Federal Express. FedEx has been had a giant bull run. It peaked up here in May of a year ago, frankly, and sold off. But this week it retook its 50-day. It's above the 50-week and the 17-week moving average. On the daily chart, it looks even better. And you can see the daily and the weekly bongo are bullish. It broke out above the 200 on Friday with a volume, a breakout momentum. The bongo supportive. FedEx looks to me like it's going to go higher. Now, within the healthcare space, we talked last week on my morning or my pre-market short videos. I usually identify 2 or 3 stocks. One was Bristol Myers Squibb. We identified it here because of the 3 dots, and then it broke out the next day above the 50 and gapped up again on Friday. We talked about Lilly, LLY. And Lilly just had a fantastic Friday and Thursday, and we called it here on Wednesday, I believe, or Tuesday, whichever the 21st was, and we picked it up because of the 3 dots. It's sort of a pattern that I look for. Now, what I'm seeing in the markets is a lot of junk off the bottom. Big Pharma aside, what you're seeing are stocks that look like American Eagle Outfitters, AEO. The stock has been in, this is the wrong one, American Eagle. Well, let me get that. Well, I had the right ticker. I just was in the wrong market. And this is what American Eagle Outfitters looks like. This stock has come down from a peak back in June of 2021 of about $38 down to $12. Now, at some point, the stock's going to recover. The rate of descent has sort of dropped so much that it gave us a daily bongo green on Friday with a breakout and momentum. Still has to clear the 50 and the 200-day moving average. and look at relative strength turned up. Do I usually buy stocks that look like? No, but that's what you see in the markets. LABU, and talking about that as a leveraged ETF for biotech. And what did this one show us? Similar pattern. Big fall, big fall. This one was $138 in February 2021. It's now trading for $7.57. LABU broke above the 50, and although that's a red candle, it was still up 3% on Friday. So LABU looks interesting here, but like so many stocks in this market, it's had a big sell-off. Wolf is a technology stock that looks interesting here, but why? Because it had a gap up, closed at the high of the day, high volume breakout momentum, and a new bongo on the daily, and you could see relative strength and OBV turned up. Everything from my line over looks great. The problem is the stock's in a deep uptrend and it's got lots of overhead supply. So this is a very challenging market. Here's another one, Assured Guarantee. This is a insurance stock. And the other thing that was moving when I did my large review was insurance stocks. Now this has been in a longer term uptrend. It's pulled back here. Looks like it wants to go. It took out the 50 and the 17 with momentum, breakout, and volume, and again, supported relative strength and on-balance volume. So my word is the markets look like they want to go higher here, but be careful because bear market rallies fail. But if there was a time to have a little bit of improved sentiment, maybe we're looking at it with the positive seasonality. Tacticals trunk seasonality. Right now, the technicals look pretty good too. Have an outstanding week, and we'll talk to you next weekend. Thank you. Don't forget, register for the Wealth 365. Look for the address in my remarks in YouTube. Thank you.